You have $100,000 in savings and want to know what your best option is. A safe guess would be putting it into a savings account. On average, a 0.5% interest rate on a savings account would earn you about $500 a year. But with inflation averaging 3%, your money's real value drops to $97,000, a loss of $3,000 in purchasing power. But what if you could invest that $100,000 into something that turns it into millions? That's where investing in ETFs like QQQM and SCHD comes in. In this video, I'll show you and John the differences between these two ETFs, covering their strategies for generating returns and the potential risks involved. In the end, I'll present a side-by-side comparison of investing $100,000 in each ETF over the long term and how they can transform $100,000 into a seven-figure portfolio that pays over $300,000 in annual dividends. Okay, so let's start with the basics. What exactly are QQQM and SCHD, and why are they such popular picks for investors? First up, we've got QQQM, the Invesco NASDAQ 100 ETF. It's the baby brother of the famous QQQ, but with a smaller price tag. It focuses exclusively on the NASDAQ 100 index, which means it's packed with high-growth, innovation-driven companies like Apple, NVIDIA, and Microsoft. This ETF thrives in the world of tech, communication, and consumer discretionary sectors, basically industries that scream future. Now on to SCHD, the Schwab U.S. Dividend Equity ETF. It focuses on high dividend-yielding U.S. stocks and companies with strong fundamentals. Basically, the grown-ups in the investing world. It invests in industries like financials, healthcare, and consumer defensive sectors. This ETF is all about balance. It's built for stability and long-term investors who love the idea of cash flow without all the drama. Here's another key difference: expense ratios. SCHD is famously cheap to hold, with an expense ratio of just 0.06%, while QQQM charges a still reasonable 0.15%. Over decades, these savings, though, can really add up, especially for buy and hold investors. So which one is best for you? The tech-driven, high-risk, high-reward star in QQQM, or the reliable income-generating machine in SCHD? Understanding these differences is crucial for making an informed investment decision. Which brings us to holdings and diversification. First, let's talk about QQQM. This ETF is all about the NASDAQ 100, which means it's dominated by tech. In fact, it has a 50.85% allocation to technology, with big players like Apple, NVIDIA, and Microsoft leading the pack. Add in sectors like communication and consumer discretionary, and it's clear QQQM is on the innovation train. Companies like Amazon, Meta, and Tesla also make the top 10, which accounts for over 52% of the total portfolio. That's a lot of weight on just a few names. This concentrated approach means QQQM has the potential to deliver explosive growth, but it can also make your portfolio feel the pain if the tech sector hits a rough patch. On the other hand, SCHD takes a more balanced, diversified approach. Its largest sector exposure is in financials, followed by healthcare and consumer defense. These are dependable industries that are a lot less likely to swing wildly with the market. SCHD's top holdings include Cisco Systems, Home Depot, and Pfizer, all solid dividend-paying companies. What's interesting here is that SCHD's top 10 holdings make up only 40.9% of the portfolio, which spreads out the risk compared to QQQM's more concentrated approach. So what does all this mean for you? Well, if you're after aggressive growth and don't mind a little turbulence along the way, QQQM's heavy reliance on tech could be your ticket. On the other hand, if you prefer a steadier, more predictable portfolio with a focus on income, SCHD's diversified lineup might feel like the safer bet. Alright, so now that we know what these ETFs hold, how do they actually perform? Let's take a look at how QQQM and SCHD have delivered for investors over the years. First up, QQQM. This ETF thrives when the market is bullish, and its numbers prove it. Over the past year, QQQM posted an impressive 32.13% return, outpacing SCHD's 17.96%. This is thanks to its heavy exposure to tech, which surged as companies like Nvidia and Apple continued to dominate. When we zoom out to the past 5 years, QQQM's returns are even more eye-catching. 77.65%, nearly doubling SCHD's 50.42%. Now let's look at SCHD. While it might not grab headlines like QQQM, it's built for consistency. Over the past 10 years, SCHD has delivered an impressive 114.28% total return, highlighting its long-term reliability. Sure, its one-year return of 17.96% can't match QQQM's, but SCHD shines during market downturns, offering stability when volatility hits. Its dividend payouts also provide a layer of returns that doesn't rely on market performance, which is a big plus for income-focused investors. Here's the thing, these performance differences tell us a lot about what kind of investor each ETF is designed for. If you're someone who loves growth and doesn't mind riding the highs and lows of the market, QQQM is a strong contender. But if you're more cautious and value stability, SCHD has proven it can weather storms while still delivering solid long-term results. But performance alone doesn't tell the full story. And in the end, I'll show you a side-by-side projection of both ETFs and how they can transform $100,000 into a seven-figure portfolio that pays over $300,000 in annual dividends. Up next, I'll dig into dividends because while QQQM focuses on capital appreciation, SCHD's dividend strategy is what makes it a fan favorite for so many investors. Let's break it down. This is where QQQM and SCHD really show their differences. If you're looking for cash flow or reinvestment opportunities, SCHD is the clear standout, but QQQM brings its own twist to the table. Starting with SCHD, this ETF is a dividend powerhouse. It boasts a current dividend yield of 3.39%, which means for every $100 you invest, you're getting $3.39 annually before reinvesting. And here's the kicker, those dividends are growing at an impressive clip. With a 10-year compound annual growth rate, CAGR, of 11.13%, SCHD becomes a compounding machine. Over time, those payouts and their reinvestment can significantly boost your returns, something I'll show you in the end. Now let's switch to QQQM. This ETF isn't built for dividend income, but it does pay out a modest yield of 0.63%. It's not much compared to SCHD, but here's the upside. QQQM's dividend growth rate is a staggering 23.62% over 3 years. That's massive, but it's starting from a much smaller base. So while you won't see much cash flow from QQQM, the growth rate means those payouts could eventually become more meaningful if you're patient. What does this mean for you as an investor? Well, if you're looking for immediate income or a steady stream to reinvest, SCHD is the obvious choice. Its high yield and consistent growth make it a favorite for dividend-focused strategies. But if your priority is capital growth, QQQM's dividends are more of a cherry on top, not the main dish. Dividends are just one piece of the puzzle, though. Now let's take a closer look at how a $100,000 investment in each ETF could grow over 30 years, factoring in both capital appreciation and dividends. Okay, now for the part we've all been waiting for. What happens if you invest $100,000 in QQQM or SCHD and let it grow for 30 years? These pure projections here are based on historical performance and current metrics. Let's see how they stack up. First, let's break down SCHD. This ETF is all about steady growth and reliable income, starting with a current dividend yield of 3.39%, backed by 11.13% of dividend growth. SCHD also has an average share price appreciation of 8.14% annually. If you invested $100,000, here's how it could grow. After 1 year, your investment would be worth $111,530 thanks to share price growth and dividends. After 10 years, the same investment grows to $311,251. Give it 10 more years, and in 20 years, things start to compound, reaching a value of $1,090,176. Fast forward to 30 years, your investment could grow to an impressive $4,464,608. After 30 years, SCHD's dividends alone could provide an annual income of $306,326, or about $25,527 per month. In total, your gains would include $2,397,530 from capital appreciation and another $1,967,079 from reinvested dividends. It's the classic tortoise story. Slow and steady wins the race for income and stability. Of course, the question is, can QQQM beat that? Let's break it down. QQQM has an average share price appreciation of 16.06% annually and a more modest dividend yield of 0.63%. Now, since it's only been around for 4 years, I'll take a more conservative dividend growth rate of about 10%. See, QQQM is all about capital growth, so here's what happens to a $100,000 investment. After 1 year, your portfolio would grow to $116,690, reflecting QQQM's rapid growth. In 10 years, it'll be valued at $462,242, more than SCHD at this stage. Give it 10 more years, and in 20 years, the investment will be valued at $2,095,853. Finally, fast forward to 30 years, and your investment has the potential to reach a valuation of $9,405,079, more than double SCHD's final value. Now here's the catch. QQQM isn't much of a dividend payer. After 30 years, its dividends would provide annual income of just $8,323, or about $694 per month. Almost all the gains, $9,213,324, come from capital appreciation, with only $91,755 contributed by reinvested dividends. It's a high-risk, high-reward strategy that relies heavily on the tech sector's continued dominance. So what's the takeaway? We saw how QQQM and SCHD perform, what they're made of, and how they could grow over time. But here's the big question. Which one fits your investing style? Keep in mind, no ETF is inherently better than the other. It all depends on your unique financial situation and goals. If you're chasing growth and can handle volatility, QQQM could be your match, with its $9.4 million 30-year projection driven by tech giants. But for those seeking stability and income, SCHD is the standout, offering $4.46 million in growth plus $306,326 in annual dividends after 30 years. All in all, the choice boils down to your goals: aggressive growth with QQQM or reliable dividends and consistency with SCHD. Neither is better. It's all about what works for you. Want to know how to reach the same valuation and dividend income using only $10,000? Click the video on the screen to find out.